I became a huge tax nerd. And I basically read through the entire Canadian tax code for fun. Not only did we have to learn English, because they didn't know English, but they also had to learn what the free market is, what capitalism is, how to open a bank account, right? I just trust that the thousands of employees at Apple, they're gonna work hard to make me money. You know, if you eat out every day at lunch, right? And you're spending $10, $15 a day at lunch, you might think, okay, $10, $15 a day is not a lot, right? You do that 5 days a week, and then over the course of months, you could be spending hundreds of dollars. Every day for most of my career, I packed a sandwich to lunch. I don't drink Starbucks coffee every day, but I own Starbucks stock because I know that most people buy Starbucks coffee every day. For sure, I definitely recommend everyone should be roughly 50-50 between Canada and US. What Norbert's Gambit is, it's a really cool technique which allows you to convert Canadian dollars into US dollars or vice versa without paying any currency conversion fees. Crypto doesn't have a long-term track record. I enjoy going to the casino and playing blackjack. I have fun. Real estate is actually the fundamental backbone of my long-term wealth strategy. Your principal residence, I don't really consider an investment.
100%.
If it doesn't cash flow on day one, it's unlikely to cash flow down the line.
All right, Adrian, I'm so excited.
I'm excited too. Thanks for having me.
No, thanks for coming here. I would love to first of all know, what is it that I need to know, from your past that
goodness.
makes you who you are today? Like,
Okay. Do you want the long version or the short version?
it's up to you. It's a podcast. Right?
Okay, sure.
We can go on.
I guess I'll do a little bit of an intro for everyone who might not know
Yeah.
who I am. Yeah, so my name's Adrian. I'm the Canadian T-shirt. I've been running a YouTube channel for the past 4 years. And I guess the story of how I got started, so I guess I'll start from the beginning. Yeah, so I was actually born in Romania, and we came here when I was very young. And my journey with money and investing definitely began with my parents. But the interesting thing was my parents. So we came from Romania, which was a formerly communist country, right? And if you guys know, like in a communist country, there's no such thing as private ownership. There's no such thing as assets. You don't own a car. You don't have a bank account. You can't own property. It's all state run, right? You have like food rations, that kind of thing. So when my parents came to Canada, not only did we have to learn English because they didn't know English, but they also had to learn what the free market is, what capitalism is, how to open a bank account, right?
Wow.
How checks work, that kind of thing. So all that was brand new. So investing was definitely not a priority for my parents, right? They were just busy, raising two young boys, right? And trying to, get a life started in Canada. So I never learned investing from my parents, but the lesson that I did learn that for me was invaluable was the value of the dollar, right? And the value of cutting your expenses, living below your means, and saving every amount of dollar you can, right? And that was, like, for me, that's the lesson that they instilled the most, and it's the one that I'm most grateful for, right? Because all of my life, I've always been extremely frugal, and I have no one but my parents to thank for that. But then fast forward to university, I was studying to be a quantum physics professor. I was studying mathematical physics.
Really?
So
Wow.
that was kind of my journey. But on the side, I always kind of did a couple part-time jobs and like business contracts. I did a lot of like software engineering, so I did a lot of like contract software development, web development, that kind of thing. So I always had multiple like side businesses going on. And really early on, probably in the first or second year of university, I became a huge tax nerd. And I basically read through the entire Canadian tax code
Wow.
for fun, right? Right?
Okay.
Which most people don't do. But the
You
reason
have a very different idea of fun.
exactly, right? But the reason why I did that was because like I know how hard I studied. I know how hard I worked for my money. So I want to make sure my money's working as hard for me. And I didn't want to throw money down the drain on unnecessary taxes or fees. So that's why I was really into the idea of like entrepreneurship and starting a business because I was aware of those huge tax incentives and tax benefits you can get from being a business owner, right? So all throughout university, I was working side gigs, and that was great. But I was always limited by my time, right? I only got paid when I was working a contract, right? If I didn't work, I don't make any money. So then I started realizing, okay, well, I'm saving my money. I have tax efficient income from my businesses, but what could I do on the side? So all the money that my net income was always going to savings accounts, right? But back then, we're talking like 2011, 2012. I mean, I was getting a 0.5% savings account with TD. I was getting maybe like 1 point something percent with Tangerine. Well, back then it was called ING Direct, right? And that was the best I could hope for. And then every once in a while, ING Direct would offer like a promotional rate of like 3% for a couple months, and I thought, wow, that's amazing, right? I get 3% of my income. And then I started thinking, I'm like, wait, like why is the bank offering me 3%? If they're giving me 3% guaranteed, no, they must be making a profit of that. So they must be making more than 3% to reward themselves for paying me 3%. So I started thinking, well, how does that work? And then I realized, oh wait, no, I'm giving them my money. They're paying me 3%, but they're taking my money and investing with it. And they're making way more than 3%, and they keep the difference, right? And when that clicked on me, I was like, okay, well, then there you go. Like,
you can do that too.
If they're doing that, I could do that too. So that's when I really started investing. That was probably like second year of university. But still, I was still kind of a beginner. I didn't really know too much about stocks and that kind of thing. So I thought, I kind of believed in the common narrative that most Canadians have heard for decades, right? Which is stock market is scary. It's only for the experts. Don't try doing that on your own. Trust us with your money and buy mutual funds. It's less risk and we'll kind of, hold your hand through the process. So that's what I did. I did mutual funds for maybe about a year. And at first it was super exciting, right? Because unlike a savings account where your money just kind of sits there flat and then at the end of the month you get a nice little tiny interest thing, right? Now, every day my mutual fund went up and down. And that was definitely kind of exciting to keep track of. And then after a couple months, I received my very first dividend. And that was like a huge dopamine rush for me. Because oh my goodness, not only is my money generally going up, but I just got like a large cash flow at the end because of a dividend. And I ran the math on it, like the amount of dividend I received versus how much money I had invested. And that essentially dividend yield was significantly higher than a 3% savings rate I would have gone with the bank. So I thought this is a great idea. And then I started thinking, I did that for a couple more months. And then I realized so I'm always thinking okay, if someone's helping me or if I'm getting benefit from something, how are they benefiting from it too? So I started thinking to myself, okay, how is in that case, it was ING Direct / and then eventually turned into Tangerine. How is Tangerine making money from the mutual funds? And I knew that they had a management fee of, I think it was around 2%, something around back then. And I was thinking, okay, 2% is not a bad deal, right? Because, I was under the impression that I think a lot of Canadians think the same way. They're taking 2% out of the profits, right? So in my mind, I was thinking, it's in their best interest to make me money because they get 2% of the profits. But then I realized, no, that's not right. It's not 2% of the profits. It's 2% of the full amount.
Yeah.
So really, if my money goes up by $500 or goes down by $500, Tangerine doesn't matter. They still get their cut.
Yeah.
Right? So then I started realizing, wait, what? So then if there's no incentive for them to make me money, and they're taking 2% every single year out of the full amount of money I have invested, why am I paying them this, right? Why am I paying for their expertise? Why can't I just replicate their portfolio and then keep the money for myself? And then that's kind of when I first got started. So I was probably in third year university when I first bought my first direct stocks and ETFs. And back then, I didn't even know if Questrade and Wealthsimple didn't even exist back then. So I started with TD Direct Investing, and I bought my very first stocks. I still remember to this day. It was TD stock, Enbridge, RioCan, Coca-Cola, Procter & Gamble, and Dollarama. Those were my first 6 stocks, and I've never sold them. I still hold those stocks to this day.
All right, Adrian. So how old were you at that time?
When I first started buying my stocks?
Yeah, the third year of university.
The first direct individual stocks would have been third year. So I would have been 20. I would have been 20 years old.
Why were you not like other 20 years old, who I'm not saying there's anything wrong, but that's a very different way of looking at life at 20.
Yeah.
So what is it that, is it only the values from parents, or do you surround yourself with people like that? Or
I would say, definitely my parents were definitely my biggest inspiration because I understand how much they sacrificed, how hard they worked. They busted their butts. They worked multiple jobs, raising 2 boys while not knowing anyone in Canada, right? So I know how much they sacrificed coming here to Canada. So I kind of felt like I owed it to them to make that journey worth it, right? I wasn't just gonna coast through life in Canada. I wanted to be successful. I wanted to work as hard as my parents did. And another combination of that was also I am an engineer. I have a very analytical brain, and I'm always about efficiency, right? I want to be as efficient with my time. I want to be as efficient with my money, and I want to be as efficient as with my energy, right? And that's why I was thinking that, I always worked really hard doing part-time jobs, business stuff, but the limiting factor there was always time because I was still, a full-time student as well, right? So if I could make passive income in my sleep with investing, right? That for me was invaluable. There's nothing else like it, right? While still working hard on my full-time job and that kind of thing, right? If I could be making money on the sleep to kind of complement that, to me, that was always like the fastest way to kind of build wealth in the long term,
and
right?
probably the easiest.
By far the easiest,
it's just the slowest,
right? And it's not even it doesn't really take much, right? It doesn't take much effort. It doesn't take, I mean, there's a little bit of effort up front to kind of like, do your research and whatnot. But once you do, I mean, once you invest in a stock like Apple, for example, right? I'm not going to the board meetings. I'm not involved in the decision-making process at all. I'm not working for Apple. I just trust that the thousands of employees at Apple, they're going to work hard to make me money, right? And that's what I do. Like, I know how hard I work. I can only imagine how hard they work, right?
Yeah.
So if I own even one share of Apple stock, I own a little piece of that company. So I own a little piece of all those profits, right?
But how about people, when they say that, oh, we want to make money quick, right? So that's where all
that's the temptation. Yeah,
because it's probably the easiest way to get started,
right?
But it's also the slowest way to get rich,
right?
Kind of, right?
Absolutely.
Probably the slowest way is putting your money in the bank account and forgetting about it.
Well, you'll never get rich. It's kind of like
exactly,
you'll break even with inflation.
But compounding is slow.
Yes, absolutely.
And it's over time. So like I bought Dollarama shares, 3 years ago.
Right.
It was a really good time to buy.
Oh yeah.
So now it's like $80 or something,
well
and
done.
I'm like, that's good because and there was a foresight that I was like, okay, things will get expensive,
right?
And people will look at discount. So all that research came in my mid-30s, right? So as a 20-year-old, if someone is watching this, like, how do you start? Obviously you follow, they follow you.
Sure.
They look at, they have access, but how do you start and how do you get outside that mindset that yes, it's a slow way of making money,
right?
But it's still way better than buying a fancy stuff that you don't need. So how do you get out of that mindset as a 20-year-old?
I guess the way I thought about it was always everyone, your money can go anywhere you want, right? It's your money, you can do what you want. You can gamble at a casino, you can buy fancy clothes that are out of fashion a year later, you can buy a fancy car that loses 30% of its value as soon as you drive it off the lot, right? Or you can live a minimalist lifestyle, live below your means, still have fun, still enjoy your life. Like for me, most of my enjoyment comes from experiences, comes from biking outside, running outside, like seeing a movie with friends, like really cost-effective ways of having fun. I've never been, just look at me, I'm not all about fashion. I always wear t-shirts every day. Like, I'm not about the flashy lifestyle. I don't care about those short-term, I guess superficial kind of status symbols, right? Because I know those aren't assets. Those are literally just money down the drain. So it's the way I always think about this is instead of buying, Starbucks coffee every day, which again, Starbucks isn't a big deal. So if that gives you pleasure in life, enjoy your Starbucks coffee. But I don't drink Starbucks coffee every day, but I own Starbucks stock because I know that most people buy Starbucks coffee every day. So when you buy Starbucks coffee, if you say, okay, let's say you spend $100 in Starbucks in a month, right? You never get that $100 back. That goes in the hands of Starbucks shareholders like me, right? But if you buy Starbucks stock, you hope that over time you're going to get even more money, right? So you don't lose that $100. That money's going to come back to you, plus the dividends, plus the long-term capital appreciation as Starbucks is profitable and grows as a company year after year.
And then you buy the Starbucks coffee with that money. Right?
That's exactly right. Then once you get your dividends, you could either reinvest those dividends, which is what I do, or if you want to treat yourself, buy yourself Starbucks coffee, right? So my mindset, my fundamental mindset has always been this, I don't need luxury items. I don't need these fancy things. What I want to do is I want to build assets that grow year after year. And then eventually, let's say I want to be for me, the biggest goal is I want to be able to retire early. I want to be able to retire before I'm, let's say maybe even 45, right? Once I get to the point where my passive income from my businesses, from my real estate, from my stock market portfolio, once my passive income exceeds my expenses, then I can retire. I can choose to stop working. I know I'm not going to. I'm a workaholic at heart. I'm going to be working till the day I die. But I have that choice. I have that freedom to retire. And at that point, once I start having that, that significant passive income, then I can start enjoying those luxury items and those fancy expenses if I want. I don't know if I'll have that desire to do so. But at that point, I'm not losing my principal money. My money's not going down to enjoy those expenses. I'm only going to enjoy those kind of luxury items once my investment income can comfortably sustain that and
That's
more
so,
so.
that's so difficult, right? That's delayed gratification.
Yeah, and that's human psychology, right? And
Yeah, so I love people say, and I have said this on our channels as well. Retract Poor Dad is probably
absolutely,
the gold class
gold
of books,
standard,
but
yeah.
I actually love Psychology of Money a little bit more.
Yes.
So how do you plan for retirement? So Psychology of Money is all about not making like you need to know where you stop. Right. So how, as an individual who is in their 20s, can plan for a retirement which is early and not 65 like they've seen their family do, like how do you plan in your early 20s or maybe in your early 30s that you need to plan for retirement in 20 years, like how do you get that sense in you?
No, so that there's a lot. That's a multifaceted problem. There's a lot of things to consider there, but I think the number one step that a lot of people, especially young people, don't do, and I've given this advice to many of my friends, people like I've met in the street, and they always say like this thing alone changed their life. Just make an Excel file or get some kind of a budgeting software and make a habit of every week track all your expenses and categorize them. Right. So if you want, you can go on my YouTube videos and I have a budget Excel template for free you can download where I literally on a weekly basis, I enter every expense and I categorize them. I have a column for my monthly living expenses. That includes rent, utilities, cell phone bill. Then I have my grocery bill. I have all my car expenses. I have all my real estate expenses, which are business expenses, right? So that doesn't apply to everyone. Then I have my miscellaneous expenses and my entertainment expenses. And the power of doing that, if you do this every week and then you group them by months, and now you can, after like 2 or 3 months, you can start to see patterns. You can start to see, wow, like most of my money is going towards eating out, my restaurant bill, right? Versus groceries. And if you see that like for 3 months in a row, my grocery expenses have gone down, but my restaurant bill has gone up, that's a red flag to you. That should be something like, oh my goodness, like I'm spending more than I might realize. And that's the power of kind of aggregating it together. Because if you go, if you eat out every day at lunch, right? And you're spending $10, $15 a day at lunch, you might think, okay, $10, $15 a day is not a lot, right? You do that 5 days a week, we're talking about, you could be like 60, 70 bucks, right?
Yeah.
And then over the course of months, you could be spending hundreds of dollars. Whereas instead, if you do those numbers, if you made yourself a sandwich, right? Which is what I did. I mean, every day for most of my career, I packed a sandwich to lunch, right? Every once in a while, I went out to lunch with my friends. Of course, that's natural. But even a simple thing as packing a sandwich, packing like, a bottle of milk or something, or like, some snacks, right? It would cost me on average maybe like $3, $4 for my lunch versus 15. And it sounds silly, but like on a day-to-day basis, not a big deal. But imagine every single day for 10 years, 15 years. That makes a big difference.
Yeah.
So just the simple act of tracking those numbers on an Excel budget or whatever kind of budgeting app you do, it can really be like a light bulb moment for a lot of people realizing, oh my goodness, I have so much money going in these places. And then you start to realize, wow, maybe I don't need this thing. Like if I'm paying, I don't know, $25 a month for Netflix, I'm also paying $20 a month for Disney Plus, $15 a month for Amazon Prime, and I only really use Netflix. Like a lot of people, they don't really realize that because it kind of comes out of the credit card, becomes like an automatic thing. But if you have it on Excel and you can see those numbers in front of you, it can really kind of be like an eye-opening experience for people to be like,
absolutely,
I can maybe cut down on these expenses. Or if you don't want to cut down on expenses, at least you can track. Another thing I recommend is, you have like a monthly total of what your expenses were for the month, but also have a monthly income, right?
Yeah.
Track your net income, what you get from your paycheck after taxes, after CPP, all that stuff, and whatever if you have business income or investment income. Track those two numbers. And if your income does not exceed your monthly expenses by at least, I would say a 10%, 15% margin, you need to make some changes.
Yeah.
Right? Increase your income. You should always try to do that, right? But it's hard, right? It's hard. Like, trying to get a salary increase, trying to get a promotion is tough. Doing a side business, doing a side gig is very tough. Most people, I think, should try to do it, but it takes time. Oftentimes, the much easier approach to get the same net income result is to lower your expenses, which is something everyone can do, right? So I think for me, when it comes to retirement, that's where it starts, right? You can't really make a plan for retirement or any kind of long-term financial goal if you don't know your current financial situation. And the biggest part of that, I think, is tracking your expenses, tracking your income, and having a very clear idea of what your monthly cash flow is. And so that way you can kind of know what to expect in the future, right? Because if you might be thinking like, oh, how much do I, a lot of, financial advisors would start the question with, well, describe what your retirement will look like. How much do you think you'll need to retire? Most people can't give you that number off the top of your head. But since I've been tracking my budget literally every week for, I don't even know, more than 10 years at this point, I can tell you exactly how much my grocery bill is going to be. Obviously, 10 years from now, we don't really know with inflation and stuff, right? But I can tell you exactly within the next 2-3 years what my grocery bill will be, what my entertainment bill will be, right? I have those numbers because I've tracked them and I've tried to keep them consistent year after year. Even as my income has grown over the years, I try to keep my expenses the same. And then that, as my income grows, that net income grows, and that's extra cash in my pocket that I can use to invest in real estate, invest in the stock market, invest in my business, that kind of thing.
No,
right?
Makes sense. And how much to save and how much to invest? That's another thing, right? So let's say you have, like a surplus of $2,000 a month.
Right.
Now, how much of that should go into savings? Should you save anything because it doesn't really give you anything? Like, I think that you should have an emergency fund.
Yeah,
but what's your philosophy on that?
No, so again, it definitely depends on your age, your circuit, a lot of different factors, right? But one big one would be, for everybody, I agree. I have a video called The 4 Steps of Building Wealth Long Term. Number 1 step was paying down high interest debts, like credit card debt, payday loan lenders. You should, if you have anything like that, if you have any debt that costs you more than 20% interest, you should never even consider investing.
That's a short way of making double-digit
exactly,
growth.
Right? Because if you pay down that debt, you're guaranteeing 20% rate of return by paying off that debt, right? So that should be number 1. Number 2 should be an emergency savings fund. And I think for every Canadian, you should have at least 3 to 6 months of your monthly expenses saved up in a high interest savings account, right? And the reason why I say high interest savings account is because it's risk-free. That money is liquid. If you need it at a moment's notice, you can withdraw it and you can get that money in your bank account within a day, right? Sure, you're not going to be getting crazy returns on that. The best thing you can do right now, the best flat rate interest savings account right now is EQ Bank, which they pay 2.5%. Again, that basically keeps pace with inflation, right? There are some promotional rates. You might get like a 3.5 or a 5% promotional rate, but only for a few months. So definitely take advantage of that. But I say everyone should have at least 3 to 6 months locked away in an emergency savings fund. The main point of there is the emergency fund is not to build wealth, right? It's just there mainly to protect your investments because unexpected emergencies are going to happen. You're going to have car trouble. Your furnace is going to break down. Tree's going to fall on your roof, whatever, right? Your dog needs to go to the vet, right? And if you don't have that cash on hand, you're going to be forced to either one, go into debt, take a loan, line of credit, credit card debt, which is going to hurt your credit score, going to cost you an interest. Or number 2, you're going to be forced to sell your investments, sell your stocks, sell your ETFs. And you never, ever want to be forced to sell your investments because we might be at a time right now where the market is a little bit in a downturn, right? And when the market is a downturn, I don't care because I don't need to sell. I hold, I let it recover. In fact, I buy more to take advantage of a discount. But if your hands are tied and you need the money today and you don't have an emergency fund, you'll be forced to sell potentially at a loss. And once you sell the money at a loss, that's money down the drain. You don't really get that back, right? So I think everyone should have an emergency fund for at least 3 to 6 months. And again, it also depends on your situation. For example, me, I'm a young guy. I don't have a family. I don't have kids depending on me. So I can afford to be a little bit more aggressive, right? I only really have 3 months in a savings fund. If you have young kids, you have a family depending on you, you probably should bump that up maybe to 6 months or maybe even higher just for the peace of mind, right? Because let's say, the way I see it is that emergency fund would be, if I were to lose my job and I lost all my income, I have enough money to keep me afloat for at least 3 months. If you have a family, those monthly expenses are higher and the stress and the pressure is much higher. So you probably want to bump it up even higher. But I think for the average person, if you were to, at worst case scenario, if you were to lose your job, and you should be able to probably find a new job within 6 months. So that emergency fund should kind of keep you afloat until you're at that point, right? So the short answer to your question would be have enough in the emergency savings fund so that you can keep yourself afloat for 3 to 6 months. But once you're at that number, then you probably don't need to be putting too much more money into the savings. At that point, leave the savings as it is. Let it kind of accumulate with that, the simple savings rate you get. All the other money you get should be going towards long-term investments. And again, deciding what to do with that is a different question entirely, right? For a lot of people, TFSA is a great way to go, right? You can't really go wrong with the TFSA, but for other people, an RRSP might be even more better, more beneficial.
So what's the difference? Like, not in terms of definitions, but who should do TFSAs, or should everyone do TFSAs first?
Right.
Or who should first do RRSPs?
That's yeah. So again, it definitely depends, right? Most of these kind of questions where it's like, oh, should I do this or should I do this? It's oftentimes it'll be a hybrid approach, right? But it really comes down to your circumstances. So bottom line is TFSA is good for everyone. There's no downsides to a TFSA. The RRSP, if you're in a high income, you have a high tax bracket, then an RSP can be even more powerful than TFSA. But if you're in a low income and you don't expect that your income will grow significantly in the next couple of years, or if you think that your income, the tax bracket you're in now will be a similar tax bracket to when you're in retirement, let's say you have a really high pension from work, then an RSP probably doesn't provide a whole lot of value. In that case, TFSA works. But if you don't have a pension, if you know that you're going to retire and your retirement income is going to be significantly lower than your working income, which is the case for most Canadians, right? Then an RSP can be even more powerful than TFSA. But the ideal situation, the ideal world where everyone's making good money, we're all in a high tax bracket, ideally, you want to max them out both, right? In addition to the other tax sheltered accounts we have, like the RESP, which is beneficial if you have kids, the brand new FHSA, the first home savings account, which is really the best of both worlds, combining the TFSA and the RSP. And then there's also other accounts. There's an RDSP if you're eligible for that. And then once all those tax sheltered accounts are maxed out, at that point you can start investing in a non-registered cash account, margin account, whatever you want to call it, and the good thing there is that there's no limits. You can do whatever you want with the money, right? But you do have to pay taxes on the dividends and capital gains that you earn.
Makes sense. How about investing in the US versus Canada? Like what's because I do feel personally that S&P 500 in the US gives a much bigger long-term return.
Historically speaking, yes.
Versus if we look at the top companies, if you invest in a BDY or one of those indexes here. So what's your philosophy on, do we split that or do we just do US? What's your philosophy on that?
So I'm for across all investment, areas of investments, I'm all about diversification, right? That includes diversifying across multiple sectors, multiple industries, multiple stocks within the industry, and a big part of that is geographic diversification, right? I love Canada. I love the Canadian economy. Some of my favorite stocks are Canadian. Some of my favorite companies are Canadian, right? But you can't neglect the United States economy. It's the most powerful economy in the world. And not only that, there are so many sectors. Some of the biggest companies in the world, especially the biggest company in the US, are sectors that are barely represented in the Canadian economy, right? Namely, healthcare. Canada doesn't have very many healthcare companies, but the big one being tech, right? In the Canadian economy, we have, I guess, Shopify is still a tech company.
32nd biggest company in Canada.
Right, exactly, right? We have OpenText, which is growing. We have BlackBerry, which is kind of a sad story, especially here in Kitchener-Waterloo. We've seen, the rise and fall of BlackBerry over the years, right? But other than that, Canada has a very limited tech sphere. Meanwhile, look at the US, the biggest company in the world. Apple is a $3 trillion company. Microsoft, Amazon, Google, NVIDIA, Tesla, but you can argue is a tech company, right? These are huge titans of the world economy. And you don't get that if you only focus exclusively on the Canadian market, right? So I definitely recommend everyone should be roughly 50-50 between Canada and US. And that's more for beginner. Once you get more advanced, you might want to also gain some more international foreign exposure. So maybe do something like 40% Canada, 40% US, and then maybe 20% into foreign markets or emerging markets, right? They are definitely higher risks. And there are definitely also higher fees associated with, foreign investing, but it is important. It is a very another kind of great opportunity that you don't really want to miss out on. So I definitely recommend, Canada and US should be roughly evenly split. But, there are also more things to consider, especially as a beginner. When you're a fresh beginner, first getting started, investing in Canadian stocks is so much easier. One, because we have Canadian dollars. You don't have to worry about any international withholding taxes, anything like that, right? With US investing, it's not hard. But there are a few extra things to consider, right? There is, you have to invest in US dollars unless you do things like an ETF or CDRs. There's also US taxes you have to consider. There's the 15% US withholding tax you face if you're receiving dividends from a US company. You can waive that in an RSP, but again, there's all these different rules you have to consider. Also, there's often strategies on how to even get started on US stocks, right? You can buy I mean, every brokerage will allow you to buy U.S. stocks, but some are definitely better than others, right? Like, I love Wealthsimple and Trade. I think they're a great platform, but I only really recommend them for Canadian focused investing. Yeah. For U.S. investing, they charge you quite expensive currency conversion fees. That's 1.5% each way when you buy or sell, right? So people, a lot of people get really caught up in the fact that, it's commission free, which is great. For Canadian investments, it is commission free. Wonderful. But you have to also consider, I'm kind of going back to where we started, right? Yeah. How are they making money? Like, what's their incentive? And then you realize, Wealthsimple, they make their money from the currency conversion fees, right? So if you are buying U.S. stocks, you're paying 1.5% while you're buying. And then, if you do that, years after year, as the stock grows in value, you also have to consider eventually when you sell that money, you're going to have to pay again 1.5% fee on a much, much larger amount. That can be thousands of dollars. Whereas I think for U.S. investing, I think Questrade is the clear winner compared to Wealthsimple because there's two main benefits. One, you can hold U.S. dollars and Canadian dollars. Wealthsimple recently launched a program where you can also hold U.S. dollars, but you pay a monthly fee for that. With Questrade for free, you can hold U.S. dollars, which what that means is if you buy a U.S. stock and then you sell the U.S. stock, your U.S. money stays in U.S. dollars. Yeah. It doesn't automatically convert, and you don't automatically charge that conversion fee. But a really cool thing, which a lot of Canadians don't realize, which is something that I preach on my channel almost every video, is something called Norbert's Gambit. What Norbert's Gambit is, it's a really cool technique which allows you to convert Canadian dollars into US dollars or vice versa without paying any currency conversion fees, right? So that can save you. I literally do that every single time I buy US stocks. And I'm not exaggerating. It has saved me.
Yes. Just if I understand this correctly. So you are converting Canadian dollars into US dollars using Norbert's Gambit.
So I'll give a very brief summary of how it works. You can watch YouTube. You can watch my YouTube tutorial if you want to see. Sure. But the very easy way of understanding it is what you do is instead of going to your bank or going to your brokerage and saying, I have Canadian dollars, can you give me US dollars? They'll always either charge you a percentage fee or at a bank, they'll use an unfavorable exchange rate, right? It'll be much worse than the actual true Canadian dollar, US dollar exchange rate, and they keep the difference, right? If you do Norbert's Gambit, here's what you do. So you buy a stock, or generally there's also an ETF called DLR. But for the sake of this explanation, you just buy a stock that's cross-listed, which what that means is you can buy the stock on both the Toronto Stock Exchange in Canadian dollars, but you can also buy it in the New York Stock Exchange in US dollars. So what you do is you buy the stock in the Toronto Stock Exchange in Canadian dollars, then you contact Questrade or your brokerage, and you tell them, I want to journal those shares from the Toronto Stock Exchange into the same stock in the New York Stock Exchange. Okay. And that journaling is free. It doesn't cost you anything. But now that it's been journaled over into the New York Stock Exchange, that stock is now in US dollars. It's the same stock. It's worth the same amount of money, but it's in US dollars. And now all you have to do is sell that stock, and you sell it in US dollars. So the benefit there is now you're not paying a percentage, 1.5% fee of that amount. You're paying essentially a fixed fee of usually $5 to sell the stock, right? Sense. So if you're doing... let's say if you're doing $1,000 converting, right? And if you use Wealthsimple, 1.5% of $1,000, that's $15 one way. And then when you sell, another $15. So $30 total, right? If you use Norbert's Gambit with Questrade, it will literally cost you a flat fee of $5. And the more money, the more the savings, the more benefit you get, right? Makes if you sense. Do $10,000, now it's again $5 with Norbert's Gambit. And now it's going to be $150 with Wealthsimple, and more, right? So I've spoken to a lot of people in my YouTube comments and stuff where they said, I cashed out my my pension plan at work and I wanted to convert $50,000 of my RRSP, right? If they used Wealthsimple or a bank or something, imagine that a 1.5% or a 2% conversion fee on $50,000. That's literally thousands of dollars, right? Over a long term. Whereas if you did Norbert's Gambit with Questrade, it would be roughly $5, maybe $6, $7, basically a flat fee. And so that's something a lot of Canadians don't know. And it's something very important, especially when you're a beginner. If you're going to get started with U.S. investing, don't get discouraged. I know sometimes it kind of sounds a little overwhelming, a little scary. Norbert's Gambit, conversion fees, all these kind of fancy words, right?
And you just don't do it because of that, right?
Yeah, don't let that stop you from investing in the U.S. market. But as you kind of get more comfortable with investing and buying stocks in general, right, it's definitely worth learning the more cost-effective ways of investing in the U.S. market.
I'll probably put a link in the
yes,
like
please.
the description of your channel, so on this video especially, right? Sure. So that anyone who is watching this, they can just go there and do that.
Thank you.
So I do want to understand a little bit, when like in this market, right?
Right.
When you see that the market is actually going down, a lot of people get discouraged, right? So because they have a habit of sometimes watching their portfolios every day, and they're like, oh, I'm down 2% today, and then like next week, like the Silicon Valley collapse happened, I'm down 5% today, right? So how do you get out of that? I know that people need to get out of that, right? So we probably need to look at our portfolios once in every 6 months, right? So maybe less, if you are more of a long-term 30-year investor. So how did you? I'm pretty sure you dealt with this yourself.
No. So everyone deals with this, right? It's not like it's one of those things where when you first get started with investing, you're gonna get super excited, you're gonna get super passionate about it, and you're going to be logging into your account and checking your portfolio multiple times a day. It's gonna happen. Like I'm telling you right now, like it's gonna happen. I was guilty of that. Everyone I know has been guilty of that, right? Which is fine because it's a new thing. You've never done it before, and it is exciting. When markets going up, it's super exciting. When markets are going down, it can be a little terrifying sometimes, right? But it really, one, building that discipline of ignoring the short-term volatility and just ignoring the noise, there's no real shortcut about it. It really just comes with time and experience. I've made so many videos talking about what to do in a market downturn, what to do in a market crash, how not to freak out, how not to panic. But like hearing someone say those words, it's easy to hear those words and be like, yeah, I'll be calm when it happens. But when it finally happens to you and your money, you're seeing red losses on your portfolio, for anybody, it's hard to kind of maintain that discipline and maintain that emotional calm, right? But the way I see it, the way I've always told myself is, like, as long as nothing has fundamentally changed with the company, right? These short-term ups and downs don't mean anything. Nothing has changed, right? It's like if Apple stock drops by 5% today, right? Has anything actually changed with the company? Have the iPhone stopped working? Has their factories like exploded? No, like they're still making an amazing product. They still have an incredibly loyal customer base, and they're still incredibly profitable quarter after quarter, year after year. Every year the revenue goes up, their net income goes up, the costs go down, right? Like clockwork. So when the stock price goes down 5% in a week or in a day, that doesn't mean there's no real fundamental real world response to that. That's just emotional. That's just an emotional response by maybe one big investor sold money and then someone else kind of caught on board and then someone gets freaked out and then kind of gains like a momentum, kind of gains like a it spreads like a fever, right? But as long as you can kind of remember like just remember the fundamentals. Why am I investing in Apple? I'm investing in them because I know if you zoom out over the course of 5 years, 10 years, 20 years, this company will always be profitable and always grow. Here's a really great stat that I always kind of go back to is there was a book called Beat the Bank by Larry Bates, and he really illustrated this very well, which kind of resonated with me when I first read the book. I think must have been like about 10 years ago now, but if you look, they did a very comprehensive study of the U.S. stock market, the S&P 500, I think ever since 1930, something like that. So let's say give or take almost about 100 years, right? And in the full span of 100 years, they looked at every single time window of every single trading day, every single 1 year period, every single 5 year period, 10-year period, etc. And here's what they found. If you look at for the past 100 years, every single 1 day period, about 55% of those single days, the market saw a profit, went up. 45% of the 1 days, the market went down. So if you want to make it simple math, if you're looking over the course of a 1 day, very short term, you have roughly a 50-50 chance of gaining money, 50-50 chance of losing money, right? Now let's zoom out. Now, if you zoom out over the course of 1 year, so over the past 100 years, looking at all 1 year time windows, 74% of those 1 year windows saw a profit. So going from 1 day to 1 year, already we go from a 50-50 chance to roughly a 75% chance of making money. Now we zoom out to 10 years. 94% of the 10-year periods, we saw a profit.
Wow.
Zooming out even further, 20 years, 100% profit. If you look in the last 100 years, there has never been a 20-year period when the market lost money. even if you bought at the high point and sold at the low point, even if you said like you sold during the Great Depression, World War II, the market crash of the 1980s, the dot-com bubble burst, the 2008 housing collapse, the 2020 market COVID crash, the 2022 crash, right, with the interest rates. If you sold at the worst point, if you bought 20 years earlier, you still would have made a profit. And that's the power of long-term investing.
That's just mathematics, right?
It's just math, right? It's that's why I don't care about short-term. Because it's short-term, it's basically flipping a coin, right? You can't outsmart the market. I don't try to outsmart the market. I just try to match the market, right? Because over the long term, the market always makes money and makes a profit, right? And like you said, it's pure mathematics.
And we have historic proof. All right, Adrian. So we talked about, I'm sure that you're not a fan of short-term investing. So I'm not going to go there, right? So we talked about, it's mathematics to invest long-term.
Right.
But I do want to talk about, two other asset classes.
Yes.
Right. So, and one of them is not gold, right? So we're not going to talk about that. So one is cryptocurrency.
Very tiny position in Bitcoin, Ethereum, but it's literally like probably about 1.5% of my overall portfolio, so it's tiny. In fact, I actually do have so to answer your question, I do have a video I made probably about a year ago titled Why I Avoid Crypto. Okay. And it was by far my most controversial video. Like, if you watch most of my videos, I mean, I've made like hundreds of videos now at this point, and they're always very positive and very I don't like, talking negative about anything, right? Or and most of my videos, you can't really walk away being offended by them because it's harmless kind of stuff, right? But the audience from the crypto video, they were definitely some emotional folks there, right?
I mean, 1 year ago, crypto was doing well, right?
Well, no, so it was still at the point where it was starting to go downturn, but it was not like the low point just yet, right? And the thing is though, like I guess another important lesson with crypto, with investing, with real estate, anything, you should never ever get emotional about your investments. I'm not saying that they're junk and that there's no value there. There could be value, but those are, I wouldn't call those investing. I would call those speculating. And there's a very important difference, right? With investing, you're putting your money into a company, into an asset class with a reasonable and historically proven expectation to earn a profit, right? When I'm buying shares of Apple stock, right? What does that do? What is that? I'm buying a piece of the company. And why do I expect to gain money? Because Apple as a company makes money. They sell a product, they sell a service, they have revenue, they have expenses, they have net income. And as the net income grows, the company grows in value, and thus my share of the company grows in value. And that's how I get money, right? When you buy real estate, that's an asset. Real estate, the value of real estate grows because of demand grows, right? And if you're renting it out, you're also getting passive income through rental income, right? That's how that works. Bonds make sense, the same thing, right? You're essentially loaning money to the government or to a company, and they pay you back bond interest. So you're getting passive income there. And again, you can sell the bond for future value, hopefully get some capital gains as well. When you're doing something like crypto or NFTs, the reason why I don't call it investing is because the only way to make money with those is to sell it for someone else at a higher price, right? So there's no fundamental value to these. The only goal is I bought it for a certain price, and I hope that down the line I can convince someone else to buy it for a higher price. But there's no financial metrics to evaluate it. Like with a stock, you have price to earnings ratio, you have earnings per share, you have beta values, you have all these different financial metrics.
You can touch an iPhone, right?
Exactly, right? You can tell when a stock is overvalued, undervalued, or fairly valued, right? With Bitcoin, all we really know is the volume of trades, the price of it, and like how many people are kind of using on a daily basis. But now, I mean, we've seen from the highs, it's kind of dropped by like, roughly 50. I think at one point it dropped by like 65% off its high values, right? And then people are saying, oh, don't worry, it's going to recover. And my challenge is, I mean, I hope it does recover, don't get me wrong. But my challenge is, why should it recover? Why does it deserve to recover? Like TD stock right now is down, I don't know, let's say, I don't know the number, but it's down quite a bit from its highs. Maybe about 10% from its highs, right? But will it recover? Yes, I'm very confident. Why? Because if you look quarter to quarter. Over the past like several years, every quarter its revenue goes up, its net income goes up. So that's why I know it's going to be worth more in the future, right? Because the company is worth more because it's getting more money. There's cash flow. With Bitcoin, it's like the only way I can justify it going up is because we could say, oh, I hope that this whatever market cycle we're in will pass, and then interest will grow yet again. But another thing to consider is a lot of people will say things like, "Oh, don't worry, this is a cycle. We've seen this many times." But when it comes to crypto, we actually haven't seen this before. Crypto doesn't have a long-term track record. Bitcoin was only invented about 10 years ago, but it was only really in the public consciousness for maybe about the past 5-6 years. So that's a very short time span. And even more important to consider, in these past 5-6 years, it's been essentially 5-6 years of a bull market where we had record low interest rates, record low inflation, all this money pumping into the latest tech companies, penny stocks, growth stocks, speculative plays like Bitcoin, like crypto,
Absolutely.
right? Now we're not in that environment anymore. Crypto and Bitcoin has never been tested in a high inflation, high interest rate market. So we don't know how it's going to perform. I mean, we've seen how it's been performing. It hasn't been performing well. It's been suffering, right? And when people are saying, oh, don't worry, we've seen this before, it's going to recover like it used to, I don't know. I mean, I hope it does.
I think that's a really important point that it has never seen.
It's never been tested in this environment.
Yeah.
Right?
Because it started, in 2010?
Exactly.
2010. So
right.
That was after the subprime crisis.
Exactly.
So we have never seen
a
recession.
It, right? So again, I hope my thesis is wrong. I mean, again, I have a little bit of money in crypto too. That's why I don't want to lose money off it. So my advice would be is don't blindly listen to all the hype. There's so much hype. With anything online, don't fall for the trendy clickbait videos. Don't fall for the bold claims you'll hear of like, oh, I can 10x your money overnight, or you can get rich quick. Most of that is BS, right? If you want to invest in more risky speculative plays, that's fine. It's your money. You're allowed to do it. I enjoy going to the casino and playing blackjack. I have fun. I don't go there with the expectation of making money. I know. I mean, I'm a mathematician. I know that the house has roughly a 48% chance. Sorry, I have a 48% chance of winning. They have a 52% chance of gaining money, right? So I know the odds are slightly against me, but I have fun. And I only go in the casino with $30 in my pocket. If I lose $30, I walk away, right? So I really don't mind losing that. And that's kind of the same philosophy I would say for these really risky plays, whether that's an IPO, whether that's a penny stock, whether that's options trading, day trading, NFTs, crypto, right? Anything that's more on the speculative side and high risk, it's okay to do. Just be aware of the risks. And please, please, please don't invest with serious money that you're counting on, right?
You know what's funny? People invest, and a lot of people invested thousands of dollars into cryptocurrency.
Right.
Whereas a less riskier asset would have been their own education.
Yes.
And 100%. That would have been risky, but it would have been betting on the horse, which is you.
Right.
And that would have probably given you more returns, and then you can do whatever you want with that money.
Right.
And so I just feel that sometimes people just buy out of FOMO.
Yep.
And I've done that
100%.
In the past, right?
100%.
So we all make mistakes.
Sure.
A lot of people buy real estate out of FOMO.
Yes.
A lot of people start businesses out of FOMO.
Right.
And that just starts from, like buying cryptocurrency and thinking that, oh, that's the way to get rich and that's quick.
And when you see like a period of months where it's going up and up and up, right? You kind of fool yourself into thinking, oh, I've figured it out.
Yeah.
I've outsmarted the market. It doesn't last. It doesn't last. I mean, it's like, we've seen companies come and go, right, over the years, right? I mean, at one point, Shopify was the most valuable company in Canada, right? Now it's starting to recover a little bit, but it's dropped by. We've seen people lose 50% of their money off Shopify, right? Same kind of thing with Tesla. Again, Tesla kind of defies all logic sometimes, right? Where they have an insane price to earnings ratio, but sometimes they still kind of keep going up because they have such a loyal fan base, to say the least, right? But the point is, in the long term, fundamentals matter, right? In the short term, emotion can take over, hype and influence from big prominent figures on YouTube, on Instagram, even on the news, right? On Twitter, right? In the short term, they can manipulate the markets. But in the long term, the long-term wealth is really built by investing in quality companies that reliably earn a profit, companies that have a solid track record, companies that increase their revenue every single year, whether it's a bull market or a bear market, doesn't matter what the season is, doesn't matter what's going on around the world. Those are the kind of companies I want. The more defensive, reliable companies. And if they pay out a dividend, great. If not, I mean, that's still a good investment. The idea is I don't want to chase trends. I want to put my money, the way I see it, I live a very exciting life. I love doing adrenaline. I'm an adrenaline junkie. I love skydiving. I love bungee jumping. I love that kind of stuff. That's where I get my excitements. My investments are boring. I don't need that kind of investment that kind of excitement in my investment life. But every once in a while, if I want to do a more risky play, if I want to invest in a smaller cap company or something like Bitcoin, that's fine. It's your money. You're allowed to do it. Yeah. I would just say a small percentage of your portfolio, maybe like less than 5%. Yeah. Meaning like if I lose it, right? If I lose it, you're going to survive. You're not going to be financially devastated, right? But I mean, I get these messages in my comments sometimes. People saying like, "Oh, I have 40% of my retirement in crypto," and it's like, oh my god, like that. I wouldn't be able to sleep.
I saw this video. I think it was on Graham Stephan's show where there was a Dogecoin guy, who at one point invested, I think, everything that he had into Dogecoin. It went up to about $3 million. So he invested about like $200,000 or something like that. It went to about $3.2 million, and he was on the show with Graham. Right. And Graham said, "Sell it now." Yeah. And he did not sell it, and that. Like we know how he lost. Is. Yeah, exactly. Yeah. Right. So I think, is it a right point to sell? Like, where do you sell? Right. So long term is long term, right?
So, So that's. See, that depends on a few things again, right? So, like, if we're talking about a stock, right?
I'm talking about the long-term investing that we talk about, right? So let's talk about TD. Let's talk about ETFs. So, like, is there a point where you sell, or what do you do?
So, I would say sell when it makes sense, like when it's your choice, right? So, let's say if you've been investing in TD for 20 years and now you're ready to retire early and you want to, take your family out on vacation and TD is in the green and you probably have a sizable profit there, then sure, sell it, right? And spend the money. But if we're right now in the market downturn and TD is maybe TD is like broken even or it's down, I wouldn't sell, right? Because I still fundamentally believe in the long-term future of the company. There's only really two scenarios where I would sell. One, where the stock is plummeted and I no longer believe in the future of the company. If I think the stock is if I don't think there's any chance of recovery, if I think the stock is going to go to zero and go bankrupt, that sucks. That's heartbreaking. But at that point, if that's really what you believe, you think there's no way out of it, then you might as well sell. Because if you wait till it gets to zero, you lose it all. Yeah. Like there's no backup plan. I mean, sometimes depending on the debt of the company, you might get a little something, but basically it'll be all gone, right? So at that point, you might want to cut your losses and sell at a loss. And there are some situations where selling could actually work out in your favor, right? If you're in a TFSA or RRSP, that's why there's never a benefit of selling. If you sell at a loss, that's money down the drain, right? And even worse, you permanently lose that contribution rate. Absolutely. Which is why I always tell people in a TFSA and RRSP, don't do the risky stocks. The risky stocks should be in a non-registered account. And the reason for that is if you sell at a loss in a non-registered account, that's either a margin account or a cash account, depending what your brokerage calls it, right? You can claim what's called a capital loss tax credit, which can basically offset any capital gains that you made, right? So if you sold Apple stock for a $200 profit, but you sold, Shopify stock for a $200 loss, they cancel each other out. So you don't pay any taxes in the end, right? So in a non-registered account, selling a stock for a loss has a tax salvage. You can salvage a tax benefit out of that, right? So that's kind of a scenario where a lot of people do sell for a loss. It's called tax loss harvesting, which can work. So you can sell at a loss when you don't think the company's going to survive. If you want to offset capital gains and you don't think this company is going to recover anytime soon, then you could also sell for a loss in a taxable account. And then finally, if it's just time, right? If you feel like, you've met your financial goals, you're retired, or it makes sense to kind of, reap some of the rewards of that profits, then sell. To me, honestly, my goal, my dream, it's kind of the same with real estate. I hope to never sell. I want to live off the dividends, basically. Live off the rental income, live off the passive income from my business, live off the dividends, right? and then maybe eventually sell or like donate my stocks to charity or donate to my kids or that kind of thing, right? But that's a very personal decision. I would say if you're in a profit, if you're in the green, you're like selling at a profit is never a bad idea.
Absolutely.
Like it's not going to hurt you, right? Like you're not going to lose money selling at a profit, right? But you might be losing out on even greater gains in the future, right? But that, again, that's a very personal decision. So that's something everyone has to decide on.
Makes sense. Let's talk about real estate for a bit.
Yeah,
I don't see you talking about real estate a lot. You do talk about it.
That's going to change. I'm actually working on a real estate video this week.
That's nice. So like, what's your philosophy on real estate, right? Should people invest? Now, should people invest in their own homes?
Yes.
Now, so even though I'm in the industry,
right.
Half the people who come to me, I actually say them that you should not buy. Because they are in not that financial situation.
Right.
They don't have emergency. So what's your, in general,
right.
That's a pretty big asset class in Canada.
Absolutely. So it's funny. Like, even though I haven't made a real estate focused video yet, I am going to be starting a real estate series very soon. But real estate is actually the fundamental backbone of my long-term wealth strategy, right? I have more. I mean, on paper, if I sold all my properties and I sold my mortgage and everything, and paid off my mortgage and everything, real estate would by far be my largest asset class, right? So I own one rental property myself. I bought it back in 2019, and then with me and my brother, we're 50-50 partners. We also own 2 other rental properties here in Kitchener-Waterloo. So I don't own the place I live. I pay rent where I live because I'm of the mindset. I mean, this is kind of, again, it's one of those controversial topics where some people kind of get emotional about it, but I'm of the mindset where your principal residence, I don't really consider an investment.
100%.
And the main reason for that is an investment is where you park money aside today with the expectation that you're going to earn money in the future. When you buy a house to live in, you're not buying it to make money. You're buying it so that you have ownership of property, you can do what you want, you have freedom, and maybe eventually, decades down the line, when you sell, you might have a little bit of profit, but that's not the goal, right? You're not buying it. You weren't running those numbers when you bought the property, right? So it can be an investment. I'm not saying it's a bad idea. Like, owning the home you own, the home you live in, it can be for peace of mind, for pride of ownership. Those are amazing psychological benefits, right? But until you decide to sell, you're not making any money. It's just expenses. You're paying property tax. You're paying for furnace repairs, roof repairs, driveway, all that stuff, right? So it's just costing you money year after year. Some of them can be tax deductible if you're running a home business or that kind of thing, right? Which is definitely take advantage of that. But the way I see it is all the properties I own are rental properties. And because those are 100% investments. And there's 2 main benefits of that. One is, I only buy a rental property where it will cash flow on day one. Meaning before I buy the house, before I place an offer, I've run the numbers. I know exactly what's my maximum buying price. I know exactly how much the mortgage will be, how much mortgage interest I'll pay every month. I know exactly how much the property tax will be, the condo fees, the home insurance, all those monthly expenses,
maintenance,
and I know, I know the area very well. I only invest in Kitchener-Waterloo because I know the city. I've lived here for like 10 years, right? I know I could probably get better cash flow opportunities in other cities, but I don't know those areas, right? I know the economy in Waterloo. I know that we have such a diversified industry here. We have the tech space, we have the universities, we have hospitals, we have manufacturing, we have all sorts of businesses, right? So I'm not worried about a factory closing down and then 10,000 people losing their jobs and then all of a sudden it's vacancies across the board. I don't think that's ever going to happen in Kitchener because we have such a diversified economy. So before I buy a house in Kitchener, I run all those numbers. I know exactly how much the rental income will be, and unless the rental income is larger than the mortgage and all those monthly expenses, and then some, right, and then a little bit of a buffer, I won't buy the property, right? Because at that point, if I'm losing cash flow from day one,
then you are working for the asset.
Basically,
the asset is not working for you, and then it doesn't make sense.
And things could change, right? You're hoping that maybe rent could go up over time, but like the way we are in Ontario, rent, we're always capped at a rent increase, right? You can only increase by like 2.5%, right? Whereas the expenses can usually increase even more than 2.5%, and we've seen that right now with interest rates if you have a variable rate mortgage. So if it doesn't cash flow on day one, it's unlikely to cash flow down the line. So even if you're kind of breaking even, a lot of people will still take that chance because at least the mortgage is kind of being paid for by the tenant, and they are building long-term equity in the house as the house grows in value. But for me, all my properties cash flowed on day one. Now with rising interest rates, one of my properties is no longer cash flowing, but it's still kind of basically breaking even. We'll see what happens in August. If they increase it again, then I'm going to be a little bit in the red. But that's also a short-term phenomenon because I know that the rates aren't going to stay this high forever.
Yeah, for sure.
Hopefully by the end of next year, we're going to start seeing them go back down. They're obviously not going to go down to the 1.5% rates we were seeing 3 years ago, but they'll go back to the more general, 2.8, 3%, something like that. And I've already accounted for that in my calculations. If we go back to that level, I'll be cash flow across all my properties once again, right? So yes, for me, my real estate strategy is long-term buy and hold rental properties. And I only really, so far I've only done single family homes. So that's usually either a freehold townhouse or a condominium style townhouse. But I only like renting out to, quality tenants, a young professional couple or a young family with kids, right? Because yes, I could make more cash flow if I rent out to like 5 students and I rent out each room, or I can make more cash flow doing short-term rentals with Airbnb. But it's so much more work, so much more risk, right? And I'm at the point where, me and my brother, we manage these properties directly, right? We don't have a property manager. And we have the benefit of, my brother lives in Waterloo. I live half the time in Waterloo, so I'm able to kind of fix the things, right? But if I was doing Airbnbs, if I was doing student rentals, so much more hands-on work, so much more late-night phone calls being like, oh, the toilet's broken, right?
Yeah.
I don't have the time to like do that myself. So in that case, I would have to find a property manager that I can trust. That's a whole other can of worms. Finding someone you can trust, also a significant expense, right? Which would affect my cash flow.
Yeah.
So there's so many different strategies with real estate, with any kind of investing, right? For me, my strategy so far has been the boring buy and hold, buy a house in a quality neighborhood. It's going to cash flow, on day one, quality tenants, very few headaches, very few, manual work on my end. Maybe every couple months I have to go into do a little bit of repairs, right? Or if I have to hire a plumber once in a while, that's fine. That's why I have that cash flow to kind of account for those unexpected expenses, which will come, right? And then years down the line, I'm earning cash flow every month, which is good, right? That's money in my pocket I can use to do whatever I want, invest or spend, but I invest it, right?
Yeah.
But the great thing is I'm building equity in the house. The house is growing in value, and I'm not paying anything. The tenant is paying for all those expenses. And here's what I really love about real estate. For me, the differentiating quality between real estate and any other asset class is the benefit of leverage, right? I'm sure you know this because you do this every day, right? But when you buy a house, you're putting in 20% of your money. The bank puts in 80%, but you gain 100% of the profits, right? The mortgage, if the house, doubles in value in 5 years, your mortgage doesn't double with it. Your mortgage stays the same or goes down as you pay it, right? So now you've basically doubled the value of the house, and you get to keep all of it, even though only 20% of the money was yours, right?
It's mathematics again.
It's amazing.
Let's say it grew by 5%.
Yes.
But because of leverage, it's much more than 5%.
100%, right?
Yeah.
There's no other asset class where you can make money off of the money you put in and the money the bank puts in.
On 5-to-1 leverage, right? But 3-to-1 leverage, you can do
You can with
options
stocks, but also those are going to be unsecured loans. You're going to be paying way higher interest rates.
Plus, there's a lot. That's what I get challenged. Like you get challenged
Absolutely.
on cryptocurrency when I say that 5-to-1 leverage.
Right.
They said no, you can do a 3-to-1, 4-to-1 sometimes leverage on stocks, and I'm like, the learning curve on those is crazy.
Absolutely.
Because you need to learn a whole new game.
And if things go down, sometimes they're going to call you on that. They're going to be like, okay, I need the money back now, right? You're forced to sell at a loss.
But you can hold
real estate. I mean, the bank doesn't want you to lose the house. It's in their best interest to have you keep the mortgage for as long as possible and pay them a reliable mortgage interest every month, right? And they'll work with you, right? Like unless things are really bad and you haven't been paying your mortgage for months and months and months, like the bank will kind of bend over backwards to kind of help you out and to kind of support you, kind of be partners in this enterprise, right?
But do you like have a budget for, different asset classes? Like how do you, let's say you have, a lot of money.
Right.
Let's say it's $100,000.
Right.
Or let's say it's $200,000. And how do you then decide, okay, this is the amount of money that I want to put in stocks because I want to diversify, and this is the amount of money that I want to put in real estate?
Right.
Like do you have a...
Absolutely. Well, again, that definitely depends on your circumstances, right?
Let's say you have $200,000.
Right.
How would you...
So in I never want to have too much cash on hand because, if you have cash in a savings account, you're losing money due to inflation, right? Whereas if you can invest...
But let's say you're saving towards it.
Sure.
Right?
So
if you have $5,000 now,
right?
But you really want to get into real estate,
right?
But you also want to invest in stocks.
There you go.
How do you balance that?
No, that's the thing, right? So here's my strategy. If I have a goal where I need this money within the next 2 years, I don't put in stocks because in 2 years that's far too short of a time frame.
Makes sense.
Right? We gave the number, right? In a 2 year time frame, you're still looking at probably around like an 85% chance of a profit, but there's still a 50% chance, historically speaking, of losing that money. And in 2 years, if your kid is going to university or you're going to buy a house and you're going to need the money for a down payment on a house, you can't afford to wait to let it recover. You need that money. That's why 2 years, anything longer than 2 years, I put in the stocks.
Makes sense.
Right? If it's 2 years or less, I would put GICs or a savings account to save for that down payment, right? And again, it also depends on if you're buying your first house. So for example, my very first house, yes, I had to save money to make a 20% down payment on the house, right? But once you start, building real estate, another main amazing thing with real estate is the power of leverage upfront, right? Having a 20% down payment, 80% mortgage, but you can also refinance the house and do a second mortgage or HELOC. And here, I'll give you an example, right? So my first house I bought in 2019. I bought it for around, here in Kitchener-Waterloo, I bought it for around $400,000, right? 20% down payment, took me years to save up, right? 20% down payment, mortgage put in 80%. I bought it, I did some fix-ups right away, and I found a tenant within a month, right? Tenant was great, cash flow positive, everything. And now I have a new tenant, but I've had this tenant for past 3 years. Fantastic, never have any problems. They're paying me every month, paying down my mortgage. I have a little bit of cash flow every month, great. But here's what's happened. In the past 4 years, that value of the house has essentially doubled. I bought it for $400,000. Now it's worth roughly $800,000, right? So what can I do? How do I benefit from that increased value? I could either sell the house, which I don't want to do. One, because I love my tenants. I don't want to kick them out of the house. But two, if I sell the house, I have to pay, realtor fees, land transfer tax, all these different taxes, right? Capital gains tax because it's a rental property. It's not a principal residence, right? All these money's down the drain. I would still make a profit because it's doubled in value, right? But I don't want to do that. I want to keep the house. I want to keep the tenants and have that monthly cash flow, but I want to still benefit from that increased equity. So what did I do? I decided to refinance. I went to my mortgage broker and I said, I want to, since the house is essentially doubled in value, I want to get a second mortgage, or in this case, I got a HELOC, right? And take out a giant loan based on that extra $400,000 of equity in the house, right? And that's what I did. I got a HELOC worth roughly maybe $280,000, right? Sure, I'm paying interest rate on that, but here's the difference. If I use that $200,000 money and I bought a fancy car, I bought a boat for personal reasons, right? All of that interest I'm paying on that new refinance is money down the drain. Yeah. But I used that money, that $200,000 loan, to buy another property, a new rental property. And since I'm using that loan for investment purposes, all of that interest is tax deductible. So now, even though now I'm paying let's say I'm at 6% interest rate on that HELOC because it's variable, right? Because it's a tax deductible, and if I'm in a roughly 40% tax bracket, I'm not paying 6% interest. In effect, I'm really only paying maybe 3.2% interest, which is pretty low. That's basically free money, right? So with that, the amazing thing was, because I bought one property and I let it grow for years and years over time, I was able to buy another rental property without any of my own money, just from refinancing the first house. So yes, it is true that now I have an extra mortgage, right? So I have more debt, but that's why it's so important. As long as you run the numbers and you know that new property will cash flow positive and it will be worth the refinance, right? Then it totally makes sense. 100%. Now I'm imagine that. To me, that is such a powerful snowball effect, right? I bought one house, then me and my brother bought a second house. We kind of saved up together for that one. Now for the third house, I was able to buy that house just from the increased value of the first house. I didn't have to save up any of my own money. And what am I going to do next time? Same kind of thing. Now, the second house I bought, now that house has also grown in value over the years. So what we're going to do, we're going to refinance that one, use that loan to buy a fourth house. Maybe a few years later, do the same thing with now the third house has gone up in value, refinance that, buy a fifth house, and so on and so forth, right? And that's such a powerful money-making machine.
As long as you don't over-leverage, and
absolutely.
as long as you know your numbers.
Absolutely, right? And that's so important. And you have to be, it's not for everybody, right? I'm the kind of person where I can rationalize and I can compartmentalize when I see those giant mortgage amounts, right? Right? I know okay, this is yes, I have a large mortgage, but it's cash flow positive. And worst case comes to worst, if I had to liquidate everything, I could sell the houses and I would still be profitable, right? Yeah. If you're the kind of person where you can't stomach seeing a mortgage like that, and it can cost you sleep, then don't do this,
There'll
right?
be a lot of those people in the comments below, but
100%, right? And if that's you, that's fine, right? You don't have to do this more aggressive investing strategy. But the thing with real estate is that you have those options.
Absolutely.
And you don't really have these options with any other asset class.
No, for sure.
Yeah.
Adrian, we can go on and on, but I'll ask you the last 4 questions.
Let's do it.
They're like the rapid 4 questions that I ask. So it's called the mindset matrix. So,
Eminem, I like it.
Eminem. Nice. So what's the best advice that you got ever and by whom?
Oh my goodness, best advice ever. It was probably, it would have been probably from a book. I was kind of like you. I read Rich Dad, Poor Dad. I read Wealthy Barber's Returns. I read Intelligent Investor. That's kind of like the gold standard. Larry Bates, Beat the Bank was great. What was the best advice I read? Probably the idea of, you don't have to blindly trust the banks or a mutual fund advisor or a financial planner. Don't let the banks or whatever or those big firms intimidate you into thinking that investing is scary and that you shouldn't. It's too risky to try on your own, right? It's risky and it's scary if you don't know what you're doing. It's kind of like moving to a new country if you don't know the language.
Absolutely.
Right? Get educated, and there's so many free sources of education, right? On YouTube. We need to watch your YouTube channel. Watch my YouTube channel. Watch other people, right? Read blogs online. Read books. Don't even have to buy the book. Rent them from the library, right? There's so much free education. Learn the fundamentals. And once you do that, you'll realize investing is not that difficult. You don't have to be a genius. You don't have to be Warren Buffett. And even someone like Warren Buffett, don't compare yourself to him because one, he's 90 years old. That's one. 2, he's got the biggest team of thousands of the brightest minds working for him. And 3, he's Warren Buffett, right? When he makes a trade, he influences the market,
Absolutely.
right? So
he buys the company, right?
Exactly, right?
5% in Coca-Cola, right?
100%, right? So even someone I respect Warren Buffett so much, but I would never blindly copy what he does because we are in totally different situations,
100%.
right? But the point is you don't have to be Warren Buffett. You don't have to be someone like me who lives and breathes stock market investing every day to get started, right? Just invest in quality companies that you believe have a long-term future, that have good fundamentals, that are profitable, right? And make sure you're diversified across multiple sectors, multiple countries, Canada and US. Don't just put all your money in tech stocks. Invest in real estate, invest in financial stocks, invest in utilities, telecoms, consumer staples, industrials, make sure all your bases are covered, right? And if you don't, and again, especially for beginners, if you don't want to, go through all the trouble of doing all the research, then don't buy individual stocks. Just buy ETFs. Don't try to outsmart the market. Literally invest in the market. Just buy the S&P 500. Just buy the TSX 250, right? Buy a wide exposure of the Canadian US market, and for literally for 90% of the people, that's the best investing strategy. Even when you get more comfortable, I still buy ETFs to this day, right? I like buying individual stocks too because they're fun. But my strategy here is I buy ETFs for the broad, safe, wide exposure. And then within those ETFs, if I want to double down on a few hidden gems or really great buying opportunities, that's what I do. Right?
Yeah. No, makes sense. Makes so much sense. Second one, and that's a 2-part question.
Okay.
So Adrian, what were you doing 10 years from today?
10 years ago? Oh, 10 years ago. So that would have been 2013. I was just in finishing up university. I was working co-op. I was working multiple co-op jobs. I was working multiple contract jobs. I was doing, I had a private tutoring business. Business really. I was a freelance tutor. I was doing a freelance web development. I was doing freelance contract software development from some of my past co-op jobs. I was studying mathematical physics. I was moving in towards biophysics. I wanted to become a cardiac surgeon at one point. So my career has been ups and downs, roller coasters, right? Then I was working as an AI engineer for multiple years.
So that was...
And then I quit all that to become a full-time YouTuber, right?
So it's funny, right? The reason why I ask you this is that we underestimate what we can do in 10 years. Like
100%.
So what would you say to the Adrian in 2013?
So you know what's funny?
Who took everything too seriously, right?
You know what? Right? That's a good question you're asking me, because the way I structure my videos and the way I build my whole channel is every time I make a video, I'm making it as a lesson to my 10-year-old self, by myself 10 years ago, right? I'm trying to teach myself the lessons that I kind of learned the hard way when I was first getting started in university or when I was fresh out of school, right? So that's kind of like, that's always been my mindset. And I think that's why my content kind of resonates with a lot of people, because, I'm not trying to talk down to people. I'm not trying to make myself sound smart by using fancy words.
You're just talking to yourself.
I'm talking to myself, literally. Right? And I'm trying to talk to myself who's starting from square one. Yeah. Someone who really doesn't know where to start, but they have the desire to do more with their lives, to do more with their money, right? So I guess, that's my biggest lesson to myself would be, don't be afraid to don't doubt yourself. Don't be afraid to get started. Don't be afraid to take charge of your career, of your financial future. Know your worth. I mean, we're going to talk about career stuff too. To myself, I mean, I was always a crazy workaholic. I remember my first job out of university. I basically invented this digital vehicle management system for this company, right?
Okay.
And it was a great job. I learned so much, and they paid me reasonably well, especially out of school, right? But I invented this system for them, right? The company, and now the company is making, I don't know how much money with it, right? But I have no ownership of it. Yeah. I invented it, but I don't have any equity in it, right? I was just paid a contract fee. The company, the CEO owns all the fruits of my labor, right? I got a nice pat on the back and I got a nice bonus, and that was great. But I learned early on, that's the benefit of starting your own business and working for yourself is, yes, it's going to be so hard. You're going to make so much sacrifices. You're going to give up nights and weekends where all your friends want to go out to the cottage or whatever, and you're going to be like, sorry, no, I have to work on my business. And you might even lose some friends along the way because they're not going to understand, Makes right? Sense. But the idea is all of the blood, sweat, and tears that you put into it, you're the one that owns the company, and you're the one that's going to reap all those rewards, right? Back when I was a full-time employee, and again, I was guilty of this for my entire career, I would always bust my ass. I would always work over long hours. I would work, 60, 70 hours a week, right? And at the end of the day, what do I get out of it, right? I'm making my boss rich.
An increment, that just barely beats inflation.
100%, right?
And if the market is bad, you get fired, right?
I might get a 3% salary boost. Yeah. Was that worth it? No, right? Whereas, trusting yourself, trusting your abilities, trusting your ambition and your work ethic and your drive and your hustle.
Makes sense.
I mean, and again, I'm not saying quit your full-time job and start a business, right?
100%.
I worked multiple jobs for multiple years until I decided to quit and do this full time, right? But don't be afraid to start a business, especially if you have a unique skill set and you can provide value to people, right? And let's say that your job teaches you. I mean, another thing I consider is that I look at all the past jobs as not just a source of income, but as a learning opportunity, right? I learned how to teach people in my YouTube videos from my tutoring gig back in the day. I learned how to make presentations and do public speaking from my last job where I led AI projects, and I had to present that my ideas and my proof of concepts to the vice president and stuff, right? So I got used to making those public, to do public speaking and conveying a lesson to people who might not be as familiar on the topic, right? all of my jobs have taught me skills which I've kind of applied in a business setting as a sole proprietorship, as a contractor, and now eventually as a full-time content creator.
Yeah.
So I think my biggest lesson, I know I've kind of answered your question many times over, but my biggest lesson to myself would be, hone your skills, learn as much as you can from your jobs and as your career and throughout your career, but don't be afraid to start a business and take a, if you're going to take a risk on yourself. Like sense. Reinvest in yourself, like you said.
Yeah.
People say like they might not want to spend $1,000 on a course or on mentorship, but
if that makes you 100 times over.
Exactly, right?
Every year.
Exactly, right? You learn these things, and I think most of us who have started a business, we can all point to like a light bulb moment where something clicked in our heads where we said like, our lives will never be the same. We'll never look at money the same. We'll never look at time the same.
Absolutely.
Right? The earlier you can find that, the better, right? Yeah.
So if you were made the president of the world for one day, what's that one rule or one one bill that you pass that everyone in the world has to follow?
I unilaterally create a law that everyone has to follow? Does it have to be a finance thing, or can it?
It can be anything.
I mean, if I could codify into law, like just treat other people the way you want to be treated. I mean, I know it's cheesy, I know, but that's the fundamental thing, right? Like
there'll be no wars.
It's so simple. No, it's so simple. When people ask, whether it's we're talking about relationship advice or career advice or anything, really anything. Like treat other people the way you'd want to be treated, right? If you think that you're like, if you're worried like, oh, am I screwing over a coworker by doing this? Think, okay, if they did it to you, how would you feel, right? Or let's talk about relationship stuff, right? If you're saying like, oh, I don't want my partner to be having lunch with someone. Well, think about if they were doing the same to you, how would you feel, right? So I would always say things like that. Like, no matter what it is, put yourself in someone else's shoes and try to have empathy for their situation, right? And don't ever like do anything opportunistic or parasitic at the expense of others, right? There are so many ways to make money. There's so many ways to further your career. There's so many ways to achieve your goals at the cost of others. And usually that's a shortcut.
Yeah.
And in the end, I truly believe this. In the long term, it won't work. It won't pay out. You can call it karma. You can call it whatever you want, right? If you burn bridges, if you screw people over, if you betray people's trust to get what you want, you might get some short-term wins. But in the long term, you lose your character, you lose your reputation, you lose your credibility. And once you lose that, what do you have? I mean, you might have a giant mansion, lots of money, and no one who cares about you, no one who trusts you, no one who's real with you and authentic with you. You might be surrounded by fake friends.
It makes sense, right? So, I always think that if you're nice to other people,
right?
And you talked about karma, right? So you don't have to. This is a world where you can actually create win-win.
Yes, 100%.
Why do you have to create a lose-lose situation or a win-lose situation?
It's not a zero-sum game.
It's
right.
It's
and I'm not saying don't just be like the stereotypical nice guy. Don't be a pushover.
Yeah.
Stand up for yourself, right? Have respect for yourself. But you can definitely advance your career and advance your relationships and advance your financial situation while doing good things. And helping people.
It could be slower, but it'll be long-lasting.
Yes,
and
absolutely.
It'll be more fulfilling.
And 100% more fulfilling, right? What you and I do, we do similar things, right? We teach people important lessons. We help people get started for a living. Could we make more money by charging them for expensive course or doing exclusively one-on-one coaching calls?
For sure.
Yes, we could, right? But the amount of fulfillment and the sense of the rewarding feeling we get when we help someone get started and years later someone will say they shake my hand and they say, thank you so much. I was new to Canada.
I told you that, right?
Yeah, no, you bumped into me on a walk and I could tell you were so appreciative of the lessons that I passed on to you, right? And I'm sure your audience feels the same way about you, right? You can't put a price on that. It's so rewarding, and I feel it's the thing I am most proud of that I've ever done in my life, right? And no question. I know I've worked hard. I know I've been doing this for so long, so I've made sacrifices. But I'm never going to lose sight of the fact of how lucky I am and how grateful I am that I get to help people for a living, and I get, and, I don't make a whole lot of money, right? But enough to sustain my life, right? And every single day, I get to go to bed thinking like, you know what? I've helped some people. I've made the world a little bit better place in certain areas, right? And for me, that's worth more than any amount of money, right?
Love it.
Yeah.
Love it. Last question. If you were to take someone out for a lunch or a dinner, and it could be anyone in the world, you have one wish,
oh my
dead or
goodness.
alive, it doesn't
Dead
matter.
or alive,
yeah,
okay.
So who would that person be and why?
Oh my goodness, that's a good question. Okay. My long-term historical figure, my favorite historical figure ever since a kid was Alexander the Great. And he's a controversial figure to say the least, but he's the kind of person where, I mean, there's things that I hate about him. He's done some horrible things, obviously. I mean, he burned Corinth to the ground, killed every man, woman, child in there, right? To assert his dominance, basically. But there are some amazing lessons that I've learned from him, right? I mean, the fact that, he inherited the kingdom of Macedonia at 17 years old, right? 17-year-old kid. Everyone thought that, we can manipulate this guy. We can, usurp his throne, whatever, right? And then within a couple of years, he conquered the world. Right, like he created the largest empire of antiquity. But the thing I respect the most about him was, he was again, it was ancient times, so people were if you were a leader, you had to kind of be cruel. You had to obviously engage in wars and battles and all that stuff, right? But once he did, conquer the Persian Empire, he didn't burn it to the ground. He made Babylon his capital. He united all the kingdoms in his empire. He built roads, he built new cities, he built libraries, and he allowed all the cultures to thrive on their own with the kind of the word would be Hellenistic, like the Greek philosophy at heart, right? So I think what I admire about him versus a lot of military commanders of ancient times is that he didn't just use the sword. And he didn't just do it for glory, just to be king of the world, right? He did make a huge, lasting impact on the world. He united cultures in a way that very few people had done up until that point, right? And that influence is still being felt today, right? I mean, everyone knows the story of the Lighthouse of Alexandria. It was one of the wonders of the world.
Crazy, right?
The Library of Alexandria was probably the greatest wealth of knowledge at all times, right? And we can only imagine what was stored there. And so he is an interesting character, very controversial character, but I would love to kind of understand his mindset of how he did the things he did, if he regretted certain things. And the fact that, he died at I think it was 31 years old, right? So imagine it's kind of, I'm 31 now. So it's like, well, what have I done in the 31 years? You know what I mean, right? So he's definitely an inspiring figure. He's I'm not the kind of person who idolizes anybody in historical figures or in modern day times. I like to look at the good and the bad, right? No matter who's your hero, there's always bad things they've done. And it's important to challenge them on that and recognize that. You don't want to just whitewash history and say, no, this person was perfect. No. Yeah. Everyone has flaws. Everyone's done some good things and bad things. It's important to recognize that, learn from that, and hopefully, don't make those same mistakes. But, so yeah, that would probably be my answer.
That's
Alexander the Great.
Amazing. That's so different.
It would be an intimidating dinner. I mean, how do I?
You must be trembling, right?
Oh my goodness, right?
I just imagine the other people around. Oh, he's having dinner with
oh my goodness. So that would be a good one.
Thank you so much, Adrian. This was so amazing.
Oh, it was been my pleasure.
We could go on and on for another 2 hours.
I'm sure we will. I'm sure we will. Yeah.
But yeah, thank you so much for doing this.
No, it was a pleasure. Thank you so much for having me on. This is my very first podcast.
Wow.
So it wasn't really. I didn't really know what to expect, but I mean, you're such a great host. I mean, it's such a free-flowing conversation. We're just having a discussion, right?
Yeah, absolutely.
I forgot the cameras were even rolling, right? So that's what we want, right?
And there were times when it was not. So
exactly. Yeah. Hey, that's content creator troubles, right? Yeah.
But
we've all been there.
Yeah, thank you so much for doing this.
My pleasure. My pleasure.
All right.